We spoke with Tiger 21's founder and chair, Michael Sonnenfeldt, and began by asking him about how his members feel about the markets and the economy, given the recent surge in rates and the fears of an economic slowdown.
You know, Brian, we have so many mixed signals in the economy. Some are pointing to a 15-year event. On the one hand, 60% of our members think we're going into recession. And on the other hand, not only have they reduced cash from 12 to 10%, but our private equity allocation is 31%, an all-time high. And if you add private equity, public equity, and real estate, it adds up to 78%, which means our members are more heavily invested than at any time in 15 years. It's kind of amazing. How do you be heavily invested and be concerned about a recession?
Well, I would assume, you're the guest, but I'll answer your question, Michael. I'm assuming the answer is that these are, to be an entrepreneur, you have to be, I think, by nature, a longer-term optimist, correct? I mean, you're also a very successful entrepreneur, so they're probably looking down the road and thinking, you know what, stocks are down last year, fine, but I'm investing for years and decades to come. I'm assuming that's what they would say.
Yeah, look, our members by accomplishment are kind of 1 in 10,000, just as an order of magnitude. If you're a major football, baseball, or basketball player, you're 1 in 17,000. So we're sort of like the all-stars of entrepreneurs. But what characterizes our members is most of them have sold a business and moved from being an entrepreneur to a wealth preserver. But they still want to roll up their shirt sleeves and get involved in businesses they can see and touch and feel, real estate they can kick, because they want to be the first to solve a problem, not the last. And when you've been doing that for 30 years, you know you can prosper in good times and bad. And I think that's probably what the signal says. But it's still a pretty stark green light, red light, and it's interesting to try and make sense of it.
It is. I got to meet so many of your members, not just at this meeting, but in the past. And I joked in my talk, Michael, I said, you love your real estate, and they do. And I think you've surveyed them, about 23% are exposed to real estate in some way. But what was interesting is that the private markets are a lot more interesting and growing every year than the public markets. In other words, just, buying public stocks like we talk about on CNBC is still interesting, but not as interesting as private markets. It really feels like the private market has come into its own the last few years.
Yeah. Well, two things. One, on the real estate, for 15 years, real estate was king. It was our largest allocation. And in part, that's because our members made so much money in real estate. They created a lot of wealth. And it's not that 23% of our members have real estate. It's 23% of the assets of all of our members is in real estate. And the reason I'm highlighting that is it had been closer to 30%. We've never seen such a fall. Real estate had been king, and now it's number 3 after private equity and public equity. And it was interesting. One of our speakers yesterday, a name everybody would know, basically said he wouldn't invest in real estate. And he's one of the largest real estate investors in the world. He thinks prices are too high and they still need to adjust. I thought it was amazing that, the wisdom of crowds, our members kind of crowdsourced to the same opinion and have been divesting real estate slowly and prudently for the last year or so.
Well, let's wrap it with this, Michael. The Federal Reserve raising interest rates again. They expect more increases ahead, a little more hawkish maybe than some people thought. How do you think higher interest rates are going to affect not only the Tiger 21 community, but to your point, real estate and all these other investments? I mean, this is one of the fastest, most aggressive rate hike cycles we have ever seen.
One of the things about a conference like this is people can express a diversity of opinions, but the overwhelming opinion is that interest rates may have peaked or they're not going to continue growing as quickly as possible. There's an old saying that there's nothing like high prices to kill high prices. And when you have high interest rates, it changes behavior so much. There's so many things going on in the economy right now with reduced demand, whether it's container rates or supply issues or used cars for that matter. These all peaked 6 months or eight months ago. And although labor is tight, many of the other components have started falling. So I think it's a better than even bet that interest rates are not going a lot higher.